So good morning again, everyone. I just want to say how much I appreciate you guys being here. Saturday morning, there's probably better things to be doing on a Saturday morning. So, for example, Mike Peterson, he's got a better thing to be doing this morning. Yesterday, he ordered some gravel, told him the wrong gravel that he wanted, and now he has pea gravel dumped in his yard that he didn't want. So he's scooping gravel this morning. Yes, it does. It does hurt. He's got a lot of gravel to scoop. They came and dumped a truck of gravel in his place, and now he's got a whole bunch of gravel he doesn't want. Um, anyway, so understanding that people have other things and lives get pretty crazy. I certainly do understand that, and not being here for the day is not a problem. I'm never offended by that. If you guys have things going on, I certainly understand. So let's jump into this and talk about earnings. We've gone through our first week of fourth quarter earnings. We really start ramping up earnings here dramatically over the next couple of weeks. They really ramp up hard, and we're going to see an awful lot of movement, possibly volatility. And one of the things I think is really important to remember is when you're thinking about earnings and how you want to manage your portfolio, we always have to consider around those earnings events the high probability of gap up or gap down opens. Yeah, no kidding, Ed. Anyone having trouble with sound? Al, you may have to reboot the room. So this week for earnings, we have a considerable number that um, are coming into play. And here, let me pull this over here. Um, we have a considerable number of earnings coming into play. If I move over here to next week, you can see how our earnings numbers really ramp up. And we're going to start hitting some of those big techs and things like that, and that can really move the market around. So you'll want to be paying attention to that. One thing I didn't know yesterday is a lot of folks had no idea that this was even in the Thinkorswim application. For those of you who have Thinkorswim, you just go to your Market Watch tab, Market Watch, and then click on Calendar, and then check mark off what you want to display. I just leave mine on earnings. I don't add anything else in here normally. But from here you can see the earnings, and if you click into a specific day, so if we go Monday, you can see in here that we have all of the earnings that are expected for Monday. And you can scroll up and down through the list. You can sort this list by time frame. I always do that. I click it by time frame, and then I can see which stocks are going to report before the bell, which stocks are going to report after the bell. So I can kind of plan my trading day based on how I think the market might be moving around these events. Okay. So you guys might want to take a look at that if you've never taken a look at that before. It's very helpful to me looking at what may be coming, what could happen. Say for example, you're holding Coca-Cola, but PepsiCo reports tomorrow. That's kind of an important thing to know, right? Because the PepsiCo earnings can certainly affect your Coke trade. So looking out into that and trying to see what's coming and being aware what's happening around you during earnings is a wise thing to do. Okay. So think about that and some of that planning that you might want to do ahead of time around these earnings reports. Now, when it comes to earnings, we know that we can get quite a little volatility. And when we have that wild volatility, a lot of people want to bet into that volatility. Anybody here still have that urge to bet on earnings? We see that everywhere out there. It comes in your email. It's all over the place. These people that are just betting, and it's just the same as going to the casino and throwing money down on a roulette wheel. It really is. It's gambling. Now, there's a difference here. If you're holding a longer term trade that has a nice profit in it, then you're probably going to be okay. If you have, let's say, a position trade, okay, and you guys see me do this from time to time, if I'm holding some positions that are coming into earnings, then I'm going to hedge those trades to protect myself around the earnings event. But on the actual just Halliburton reports on Monday morning, and me making some kind of a bet that I can predict they're going to go up or down is straight up gambling, and you have to treat it as such. It's okay if you want to do a little bit of that, if you have capital that is that you're not really worried about, or you just feel like you've got a good, strong case to build for a certain stock doing well. It's okay to do a little bit of that. Everybody gambles a little bit from time to time. But treat it like a lottery ticket. When you walk into a convenience store and think about buying a Powerball ticket, you don't walk up there and throw $1,500 down on the counter and say, yeah, let's play the Powerball this week, right? You play it small. You buy a ticket or two. And if you're going to gamble around an earnings report, do it with a small position, a small trade, something that is, you can afford to lose it. And if it goes away, again, you treat it like a lottery ticket. Okay. Now, there are, of course, strategies that you can use, and we've talked about those multiple times, where you can use strategies to hedge risk on a trade. Now, one of my favorite is still the broken wing butterfly. The broken wing butterfly for an earnings event, if you can get close to a zero cost trade, meaning it doesn't cost you to get into it, or even a credit on the trade, then you have something that will allow you to take advantage of a trade or of a potential earnings report without taking a massive risk. So take a look at, I see in that earnings list, Halliburton is going to report. So looking at this chart, would you guys be bullish or bearish on Halliburton? Would you just pass by and say, I'm not interested? So if you're bearish on the trade, then what we would do is we would look for, yeah, Paul not interested, Valerie not interested, yeah, Rickster pass. When I look at a chart like that, most of the time, if I have um, that desire to do some gambling, I'm going to do it on something that on a chart that looks a little bit better than that. You also have to be very, very careful to avoid the desire to trade credit spreads around an earnings report. Something that seems to be on the rise and that comes out in my emails and stuff like that is people betting on earnings using weekly options because they're relatively inexpensive. But the thing is, guys, a percentage loss is a percentage loss. And it doesn't really matter if it costs you 45 cents to buy an option. If you're wrong and you lose 100%, it's of the trade, that wasn't a wise decision, right? If you have that gambling money, that may be a place where you can gamble a little bit. But to make a habit of that is very, very dangerous in trading. So think about those strategies that you can use effectively around that. And one of the best, I think, is the butterfly or the broken wing butterfly to maybe take advantage of that. And by the way, guys, there are classes over, there's a full butterfly class in the YouTube, or not YouTube, in the members archive, e-learning archive, on trading butterflies, broken wing butterflies. So take advantage of that information that's out there. Do you guys have any questions about any of that stuff? How you might approach an earnings trade, or what you might do if you're in a trade that's approaching an earnings report? We've talked about that quite a few times, but I know that can be really, really confusing. And so I want to give you guys that opportunity to ask those questions and discuss Microsoft. We're in a Microsoft trade that got hurt yesterday, particularly. Got hurt yesterday. I'm looking for a rally into earnings. Okay, I'm not sure that we're going to get that at this point. If we don't see some bullishness coming into this chart really, really soon, we're going to have to just close this trade. Okay, so remember, I was basing this off of this longer term pattern. We've been holding this for a while, and we're just not getting that, inspired bullishness to move this up. And this is a trade, by the way, that I've done over and over and over and over a few years. Microsoft has had a tendency to rally toward earnings. And so I've traded this trade over and over and over and over. I can't tell you if this is going to work. Okay. Tim, all of the e-learning archives are under the e-learning archive tab on the members page. There's a lot of videos there. There's also a full class. Actually, there's a couple, maybe 3 on the ratio spread, because we did the class and then we did follow-ups and stuff for that ratio spread. Okay. So on this trade, the way this is looking right now, we may just have to close this trade to avoid the risk of earnings. Okay. The only way I normally hold a trade through an earnings report, I have to have a profit in it. Okay, I have to have a profit in the trade before I do any kind of hedging around a position. Kimberly, that's a little bit of a loaded question in the sense that um, it depends on the move. It depends on the butterfly. It depends on how much money there's in it. What you're going to have to do is utilize the Analyze tab. That's what I do. I go in and I look over and I inspect that trade on the Analyze and make those decisions. Now, I will tell you, most of the time, if I'm in a butterfly trade, a broken wing butterfly, I don't modify that trade after the earnings. If the earnings worked for me and it moves in my direction, I'm working for the credit in that butterfly trade. Okay. I'm working for that move in my direction where I had no risk on the one side. So if I have no risk on the one side of the trade, if I get direction right, I'm working for that profit in that butterfly. And that's why you want to put on a broken wing butterfly that has zero cost or a credit. And the reason I say that, if you have a broken wing butterfly that has a credit, you can't lose if it goes against you. You actually have a trade that gives you a small potential profit if you're absolutely wrong, and a bigger potential profit if you're right. Okay. Yeah, a little bit of homework. Um, yeah, on holding a position, how would you deal with a position if you're holding something longer? And then there's that question, how do I deal with that on my long term in Walmart? Great questions. So here's my Walmart trade. On 11/14, I have earnings coming in, right? I'm going to have to make a decision on this trade, what I'm going to do with this position. How am I going to hedge this trade? Okay. Now, what I typically do, a lot of folks will tell you that the thing to do would be sell calls against it. Now, you guys know I'm in down here. I have a massive profit in this trade. This and Coke has really made my year. I'm in great condition here. A few others, but obviously, just tremendous profits here on this trade. Now, this position, when I get toward earnings, this reports in November. So what I'm probably going to do is I will wait. I will wait till I get very, very close to the earnings event occurring. So say, for example, right now, earnings is tomorrow, and I'm setting right here about 119 in the trade. Okay. I'm going to go to my platform and I'm going to start looking at those options in November. There are times, it all depends when it reports. Remember, this actually reports on November 11th. So if I go to November 11th, I'm not going to have much time in this, right? I'm running out of time on this option. So that might move me to December for this trade. Okay. So I will choose between those months that gives me a little bit of opportunity to take the trade off. Okay, so let me explain this for a second. If I have a trade that's at $119, that's my profit in the trade. Now I want to think about where I would want my stop loss. Where do I want to cut off my risk in this trade? Okay, I could come over here and for $2.19, I could buy a put option that gives me the right to sell the stock at $115 a share. Okay, so if the stock were to tank, see, I don't mind if it makes a small move. I've got a huge profit in the trade. I don't mind if it wiggles down a little bit or pulls back toward trend or support. That doesn't bother me. But if it makes that big move, where do I want to get out? Where do I want to have a guarantee in the trade? Okay, and I'm going to usually buy these. I call it insurance. It's like buying insurance on your home or your car. Okay, you're just buying an insurance policy. Yes, if you own a stock, and I would say if you own a stock or an option that has a strong profit in it, Bob. If you have a strong, let's talk about this for just a second, because I think there might still be some confusion around this kind of thing. If you own an option contract that says you have the right to buy the stock at 30, the stock has moved up for you. Okay, you're now setting at 37 on this trade. You got 7 points in the trade, but you really think this trade is that true long-term hold. It's got that beautiful trend. You want to continue to hold this. This might be a Jan 2021 option, like I was looking at buying on AT&T the other day, yesterday. So you've got a long time in this. You've got a nice profit in this trade. If you go over and you buy a put, okay? If you buy a put at 35, what's your risk in this trade now? Your current price of this stock is 37. $2. Yeah, you're giving up $2 to your stop loss. That's right, plus the cost of the option. That's right. So you're giving up $2, but what essentially you're doing is locking in a profit, right? If you can buy it at 30 and sell it at 35, you're locking in a profit. All right, because what happens if the stock drops, all of a sudden that stock drops and it drops to 25? Yes, there will be some vol crush, and that's why I don't want to go to that really short-term option, because I'll have less volatility crush in that further out. So instead of November on my Walmart, I may go to December because I won't have the big vol crush. Okay. So if the stock drops to 25, what do we do here? All we have to do is exercise our contract over here. And you want to do the math because this may actually turn out to be a better trade to just close this long trade and profit from the put. But you have to do a little bit of math on this. But what you can do is just exercise this 35 put. You exercise the 35 put, it says I want to sell this stock at $35 a share. And then you'll exercise this call to bring in the stock at $30 a share. You bring in the stock at 30, you sell it at 35. You have the cost of putting the trade on, but you still protected a profit. Does that make sense? You've locked in a win. Oh, excuse me. That's how I deal with earnings events on longer term holds. So let's go back to that Walmart. On this trade, if I look at the November contracts, they've got 23.55% implied volatility. Now, that's going to go up the closer we get to earnings. Yeah, I'm buying insurance. I mean, why do we buy insurance on our homes? We don't buy insurance for the windstorm that tears a shingle or two off. We'll just fix that, right? We're buying insurance for that catastrophic event. It's the same thing that I'm doing here on the trade. I'm buying insurance for that event that I can't control. I don't know how big that storm is going to be. Okay. Now, one of the reasons I might pick the December contract over the November is if the volatility, you can see right here, this volatility is 3%. My guess is this will be much, much higher once we get closer to earnings. And this will have a much lower volatility because the earnings event is in here. So consequently, I will come over here and maybe buy my option in December so I can avoid the high implied volatility of the short-term option. When the event occurs, if I'm right on the trade, and you guys have seen me do this before. We've done this, well, some of you have. We did this when we held that long-term position in Microsoft, where we would hedge around an earnings event, and I'll buy that insurance, and the next morning the stock does a good job and the stock is moving up. I come over here and sell this. I take a small loss on this, but let's think about this for a second. Okay, why would this work? Why does this work? If the stock moves up, what's my delta on this trade? My delta is 32. Okay. Now, in an option trade, let's say you're in that longer term position, you're out here and you're well in the money, and your delta on this one is 79. So what's the math on that? If you have a chance as the stock moves up, you make 79 cents a share. And you lose 32 cents a share. Exactly. You come out as a winner, right? You have 47 cents as a winner on this, but you had insurance to protect the downside. Okay? So whatever you lose on this should be made up by the bigger delta of the longer term or the profitable trade that you're holding. Does that make sense? I know that can be a little confusing. And if you're new to this stuff, it's like, trying to drink from a fire hose. Okay? But that delta makes the difference. That delta puts me in a delta positive situation if I'm right on the trade, if I'm right on direction. What I lose over here was just the protection for the catastrophic event. I come over here, I sell this as quickly as I can, lost some money on it, paid a little insurance, but now the stock is moving in the right direction for me. Okay? If the stock goes against me, if it goes against me a little bit, probably not going to be a problem, right? If we're just pulling back to support or holding at a trend or whatever, not going to bother me. If the stock really doesn't move much, we get one of those earnings, they hit estimates and that was about it. The stock just kind of sits there. I come over here and I sell this trade. And I might at that point sell this trade and then buy or sell a call option against the position. If they just kind of hit the mark and the stock's really not moving, then there's a potential that the stock could pull back, right? Or be a slow mover to the upside. So I'll close the put and I'll sell a short call, covering any losses that came over here. Is this making sense? Now, what if the stock gets a great earnings report and bounces up huge? We get this massive move up in the stock. Okay, we just hit this one right on the head. It was perfect. The earnings come out, the stock shoots up. What have we seen lately when a stock just shoots up really, really big on an earnings report? Well, the implied volatility on the calls spike, right? Yeah, they tend to come back. The implied volatility on the call options spike. So I close my put hedge. I sell an out of the money call somewhere around 30 deltas or less up here and bring in premium that normally comes very, very close, if not completely covering my losses on the short put, the long put. And I'm back into a hedge situation here with a covered call trade. Take an example of Coke. You're in Coke. Coke reports. You're holding this trade in Coke. Let's go to a daily. That's what I need to do. Go to a daily. Coke reports and gaps way up here. So you have a short a put on to hedge the downside of this trade. Your short delta or your delta on your put option is small. The delta on your long call is big. So as this moves up, you're losing money on the put, but you're gaining more money on the call. You get this gap up move, you close the put trade and sell a call option, 30 deltas out of the money, and then this pulls back and you make money on the call, the short call. How many have I confused you guys on that? We just have to, what's really important, guys, is you understand. Okay, good. We really have to dig in and understand the rights and obligations in a stock, right? We have to understand the rights and obligations in a stock. Richard, normally, yes, I do. I will buy enough to cover the entire position. When I sell a call, Bob, I'm always going to try and sell that call around between that 45 days to expiration to 30 days to expiration. On a big spiking move like this, if you sold the November contracts that only have 28 or 29 days left, with that big spiking move, this is a big move for Coke, right? The implied volatility change, you could probably sell that, with 25 days to expiration, pick up some decent premium. Okay, but I'm always going to be searching for that option that is 45 days to expiration to 30 days to expiration so I can get the most premium out of it. And I'm always going to be looking for that option that's 30 deltas or less out of the money, giving me that high probability trade. You don't have to be all that quick, Valerie. I mean, think about it. You're watching this trade. I mean, if you know that the earnings event is coming, and you have this plan, and you've got your put option trade on to protect the trade. The earnings come out and they're good. Market opens. You just go over and close that put trade and buy or sell the call. I mean, it's not like, yeah, you just have a plan, and once you have that plan, it's just the mechanical process of what you have to go through. It's not like it's a hard thing to do. We can close trades and buy trades within seconds, right? Just know what your plan is and be prepared. So when that event occurs, you can make that decision. Now, one thing that's earnings event either happen the majority of time, they either happen after the market close or before the market open. So if you have this trade on and it happens after the market close, no trading is going to go on in that anyway. So those prices aren't changing in that trade. And so all you do is, as soon as the market opens up, you go over and make your adjustment. If it's an early morning trade and all of the hype that goes on in the early morning and you get that spike or whatever in the trade, then just make your decisions and make that adjustment. But the last thing you want to do is panic on that position and not have a thought out process of what you're going to do in the event that this goes one way or the other. Okay. Now, one of the things I normally do not do, and a lot of people go to this because they understand the covered call, is around earnings. What they'll do is they'll sell a covered call, or they'll sell that call option, trying to protect their longer term trade. But when you think about the mechanics of that, it's almost counterintuitive of what you want, right? Because we want the stock to go up. And we know around an earnings event, the stock can move up dramatically. And if you sell that covered call in that situation before the earnings report, what can happen is the stock gaps above your short call. And now you're faced with a decision to either let the stock go at that price or take the loss on the call option. And the call option loss can be pretty substantial. You could sell a call option that's 30 deltas out of the money, pick up 35 cents on the trade. The stock gaps up big. Now, the next day, that call option is worth $2. You've lost a substantial amount of your profit in that trade. So we're kind of working against our thought on the earnings. Does that make sense? Um, Barbara, that kind of a different subject, but yes, if you're looking at doing spreads, first thing in the morning, when the market is very volatile like it is right now, Barbara, you're going to see market makers at night. They will open up the bid-ask spread. They widen it out to protect themselves, just like you would. If you were the market maker and the market volatility is just crazy, the only thing you can do to protect yourself as a market maker is open the bid-ask spread up, widen it out. So what we typically have to do in volatile markets is be patient. We need to negotiate our entries into those trades at all times, but we need to be patient. Sometimes you have to give the market 15, 20 minutes for those spreads to start to normalize. I would say most of the time, Tim, I will trade, within that first hour. I don't have a problem trading within the first hour of trading, as long as those bid-ask spreads have come back together. Okay. So I don't make that a rule of saying I don't trade in the first hour. But let's use this as an example. If I'm going to pull this back and let's pull some lines off here so I have a little clear space on the chart. Let's say we have a good round of earnings. Market closed here, and it's expecting a gap up open up here. Okay. And let's assume this is a 15-minute chart or just a short-term chart. You guys hear me talk about this every day, just about, in the morning market prep video. Be careful not to chase. It's really easy to get caught up in the drama of the morning. Oh my gosh, we're gapping up 150 points. I'm missing it, right? But you guys know what I will generally do is I will be watching to see if that gap up open finds sellers and pushes it back down, or if it finds buyers to push it back up, push it on up. So I'm usually using that 15-minute chart. You don't have to use 15-minute. You can use a shorter term if you want. But I use that 15-minute because that's about the period of time, 15 to 20 minutes, those options start to normalize. So if I get that big gap, I want to make sure that that big gap is going to hold. Okay. And you have pretty good assurance, if you get that market was here, market gaps up into here, moves up a little bit, and then pulls back a couple of bars, and then we get that trade in here. When I see this occurring and buyers are stepping back up and we're holding in here, then I feel very comfortable to take long trades. I still could be wrong, but I waited for that reaction pullback, those profit takers that came in for the gap, let them do their thing, and then wait for that stock or the market to start to turn back around and show me that bullishness. Now I feel much more comfortable buying up long positions on these gappy markets like this. Okay, because the last thing I want to be doing, and it's easy to do, right? We see all these good looking charts. We want to be long, and most people want to be long. And we get that morning open that gaps up here, gaps way up, and then immediately we see, I shouldn't have done that. We see sellers jump on that, and we start pushing it back down. And everything that looked like a great trade all of a sudden starts to not look so good. Right? So if I'm patient and this pulls back and buyers then step up into here, great. But that patience will often pay off as well. So the next candle does that. And the next candle does that. Well, now suddenly I'm not thinking that the market is set up for really good long trades. In fact, what I would be watching for is that market to rally back and fail at a higher low for possible short trades. Is that making sense, guys? Tim, here's another trick that you really should pay attention to. And that is your steadfast rule that a tight bid-ask spread is steadfast. Okay, I agree with that. But have you ever done this? You look at something with a 25 or 30 cent bid-ask spread. Put an order in that's a nickel above. Okay? You put an order in that's a nickel above that bid price. You would be surprised in a volatile market how many times that order gets filled. Okay? Because those market makers aren't stupid. You know, if an order comes in and somebody wants to buy it in there, if they can make that market, they're going to fill that order if they can. And if it sits there for a while, no big deal. It may have to sit there for a little while before the market maker goes, okay, yeah, we're normalizing now, fill that order. And you get a really good price. That's right. That's right. So you don't have to wait necessarily for the bid-ask spread to come back together. You can put in the price, negotiate your entry, say, this is where I want to be in. They'll either fill you or they won't. And it's no big deal if they don't, right? Because you don't want that wide spread. But if they happen to fill you at the right price, hey, more power to you, right? So it's pretty simple to do that. I know. You can put those orders in sometimes, and as soon as you're filled, be in a profit because the bid-ask spread is still wide, and it will fill you at that lower price, and then the price will jump back, and you'll have a profit in the trade instantly. So negotiating that bid ask is extremely important, and I do that with every single trade I use. Every single trade, I am going to negotiate my entry. I am not going to settle for what the market maker tells me I have to settle for. You can see in here, we've got wider bid-ask spreads. If I were to put an order in here on this, no matter what happens, I'm always going to be going to the mid or less. If this happens to be a 40 cent spread and the mid doesn't get me down there close enough to that bid price, I will manually move it down and then submit my order. Okay. And understanding that order process is really important, particularly in volatile markets. Everybody get that? Kind of feel comfortable with that? How important that is. 15-minute chart on Coke. Take that 15-minute chart with the vol stop. Was there a long trade there and a short trade there? Yes. We've got a nice long position. Gap up, pull back. We wait for the pullback. There's your long trade into the position. The person holding this for a long-term hold through that earnings event during this period right in here is going over, closing that put option that they bought to hedge the trade. And then they come out here and go up here about 30 deltas out of money and sell a call option. Taking advantage of that implied volatility change in the chart, and selling that call option would have made money on the day. Continuing to protect your position, your longer term position in Coke. I hear you. There's in volatile markets, there's not too many penny wide spreads, but there certainly can be and sometimes, particularly in 2017, when the market was just going up and going up and going up, there's a lot of penny wide spreads. But right now they're a bit more rare, and they're a little bit harder to find because of the market volatility. Yes, it will. If you put a trade on and you're watching your brokerage platform and you put a trade on at the mid, you may see it tick up on the bid price. Why is that? The market maker has to display that. There's an order in here to buy at this price. They must display that price where somebody is bidding for the stock. But that doesn't change anything. If you're not getting filled, they have to display that price. But if you're not getting filled, it's not making any difference, right? If you get filled, hey, you got where you wanted in the trade. So yeah, you can see that tick up on the brokerage platform because there's an order sitting there for that price, and they must display that. They have to display that. It just comes with practice, Tim. You do this for as long as I have, and it's just kind of mechanical. The hard thing always for trading, I've said this a lot of times before, and people sometimes go, what do you mean trading's easy? The physical act of trading is simple, isn't it? We buy a stock that's lower hoping it goes up, or we buy a stock that's higher hoping it goes down. The physical act of trading is easy. The technical analysis adds a complication. But what really makes trading difficult for us? What's the biggest obstacle for success in trading? Yeah, us, our emotions, our discipline. Yep, that's the hardest part to deal with. And one of the reasons why I just hammer and hammer and hammer away on having a set of rules and a set of guidelines that you trade by is for that reason. And here's the thing you have to ask yourself, Tim, when you struggle with that: who's the boss? You're the boss. Be the boss. Control that emotion, because you choose to, because that is the way we do things. You don't have to be led around by that. You can choose to do otherwise. One of the things when I was younger, I don't know if anybody's ever had this problem, but when I was younger, and I mean quite a bit younger, when I was in playing football or whatever, if I felt like I had been wronged when I was boxing, if I felt I had been wronged, I would flash mad. Anyone ever done that? You flash mad, and then suddenly you become tunnel vision. You can't see any other options. Yeah, you when you flash mad like that, all of a sudden you can't make a good decision. It's impossible to do it because all of a sudden you become tunnel visioned and you cannot see the options around you. And that's really one of the things that I learned from playing football and learned from boxing is that if I could control someone else's emotion, get that punch in, get that nice hard hit that flashes that emotion in them, I now control them. Okay. And so we have to be that boss. We have to be that person that maintains that control in ourselves. Because if we allow that emotion to mess up our thinking, it eliminates the options. And I'm not talking about stock options. It eliminates that field of view on how we can address that situation. I've you guys see this in football a lot when two linemen are facing off against each other. And that one lineman gets overwound up or over emotional. It's easy if the one that's in control, the better coached, the better thinking lineman sees that in that person, because it's really easy to know what that person is going to do. That person is can only see one thing, and that's straightforward, full on attack. Right? The smart lineman just takes half a step to the side and shucks them off to the side. Because they've lost their edge in the game. The same thing is true here. If you lose your edge and flash over into that emotional trading, you lose your ability to see what could be setting up. Anybody ever taken the trade and then after the trade was over, look back and evaluate the position and go, what was I thinking? There was nothing about this trade that was right. Nothing about this trade that was good. Nothing about this trade that fit my rules. What was I thinking? We've all done that, right? Now, the truth of the matter is, a lot of times, folks, when they do that, they don't go back and evaluate that trade and evaluate themselves. We have to go back and evaluate that so that we can see, man, oh man, I was really messed up when that occurred. So think like that. Think like that very well trained or very well coached player or women are very very good at this. Women are extremely good at this with their husbands. Every woman out there knows how to push the buttons of that guy that they're with. Right? And the guys can do it pretty well with their wives. But if they're honest, their wife always wins. They're better at it. But see, that's the point that we have to come to in trading, where we look at the market and we look at what we're doing. This is a business decision. Am I being clear-headed about my decision? That's right, Linda. That's right. We all do that, right? So we have to think, if we're going to get rich in the market, we have to be the boss. We have to be in control. And I know that's difficult. One of the better things that you can do, and you've heard me talk about this a couple of times, if you've had that really bad day, had an argument with your spouse, you're all worked up about something, something's going on with one of your kids or grandkids, or something has got you compromised, the better thing to do is just not turn on the computer and trade today. Yep, that's right. Just get away. Get your head cleared. I think you've heard Rick say this a few times. You take a few losing trades in a row. What's the best thing you can do? Stand up and walk away from that computer. Smoke some chrome. That's right. Stop digging. Go outside. Go for a walk. Play with the dog. So when you are compromised, we can often spin out of control, right? We're not seeing the market correctly. We're not thinking clearly. And in that circumstance, you need to recognize that and walk away. That's right. There's always, the market's going to open tomorrow. And I have found that if I just get up away from my desk, even for just a few minutes, if I go outside, if I check on the garden, or if I go out and, sweep the garage floor, or in just a few minutes, and come back, I'm much more clear-headed to be able to focus on the market as I need to be. There's no harm, there's nothing, there's no rule that says that when you're in that bad zone that you just have to stay there and just push through and try to prove that you're better than the market, because it doesn't work. Yeah, watch a video. Put yourself back in the right frame of mind to focus on the market. One of the things that it seems really odd to me that new tech companies do very, very well is refocus or help their employees to focus, because they do different activity type things. My son, in one of his first computer engineering job, the entire company, everybody in the company, at a specific time every day, got up and went for a walk. And not just a 5 minute walk. They went for a walk, 20, 30 minutes, where they're walking right alongside their coworkers and they're chatting about different things and they're changing their state. They're becoming more focused. And then they come back and they're more productive. That's right. So think about that, guys. Think about your state of your emotions, where you are for the day. And one of the things that I learned about about me, I kind of hammer on this a lot too. Shut off that stupid TV. Because I know for me, when I listen to all that and I listen to all of the drama and all of the hype and all of that stuff going on, it messes me up. You get caught up, right? Avoid those things that create that emotional response in you, because nobody on CNBC cares about your money like you do. They don't care. They're not interested whether you make money or lose money. They're there for the entertainment value of the market. And if you find that's affecting you, creating that emotion, getting you all wound up, I can get the same information just looking at my charts and the technicals of the charts, what's going on. I don't need all of that. That's awesome, Linda. I did that for years. My office looked like, some psychopath lived there because I had charts with notes and stuff on all the walls. It was ridiculous. You didn't want to open up the door at the wrong time. It looked like it was stuff fluttering around all over the place. And then to clean up that process, I started putting everything into binders. Now I've got piles of binders. That's right. So be the boss, guys. And when that emotion starts to kick up, and it's very, very easy during an earnings event, we see the market gapping. We feel that fear of missing out. We feel that anxiety. Oh my gosh, I've got to rush. I've got to hurry. I've got to do all of those things. I'm telling you, for the most part, you do not have to rush or hurry. Think of how Ed describes when he puts a trade on. He's the banker. He's bankrolling this situation, and you had better have all of the I's dotted and T's crossed. Every blank has been filled in before that money crosses over the top of that desk. Be that business person, be the boss. That helps you control that emotion. All right. So good discussion. I didn't mean to take it in that direction, but I hope you guys got something out of today. Hey, happy to do it. You guys take care of yourselves. I want to wish you all a great weekend. Hopefully your team wins. Congrats to the Buckeyes. Have a great weekend. Enjoy yourselves, and we'll see you right back here Monday morning. You guys take care of yourselves. Talk to you soon.
I was feeling the blues. I was watching the news when this fella came on TV. He said, I'm telling you that science has proved that heartaches are healed by the sea.